So how do you then filter through all of the noise and of everything that you've just spoken about there, really drill down on what's actually meaningful and going to drive markets? Like, are there any in from what you've just said that you lean on more than others?
Yeah, I mean that's a good question. It's Howard Marks, who many of the listeners will be aware of, who's a legendary market commentator and fund manager, said that there's little logic in investor psychology. And one thing for sure is when you're looking at sentiment surveys, it's all about investor psychology, and you do see situations of things that just make no sense at all. The AAII, which I referenced before, the American Association of Institutional Investors, that survey that's published weekly, the value of that is you look at it every week, and it'll say whether people are very bullish or very bearish. Where it's really valuable is when it's at extreme settings, when the world is despairing, when it's extreme pessimism. That's normally telling you there's a buy setup coming, and equally when it's extreme optimism, it tells you a bit of caution is warranted. Right now, of course, it's mid-range. So now we've come back from those extreme pessimistic levels. We're now about mid-range, so we're not overextended. We're okay. I mentioned credit spreads, and that just tells you straight away what is the health of the credit and borrowing markets in the United States, for instance, where they're actively published. Looking at those will tell you whether there's angst at corporate level or whether there's a degree of comfort. And right now there's a strong degree of comfort that corporate America is in good shape.
And we put a pin in that earlier, but I think it's worth just dwelling on that for a second. Like, how do you explain, on one hand, the noise that we're hearing about, rising government debt levels in America, but also questions around how corporations are going to deal with changing policies on tariffs and the like, and then the fact that credit spreads are so narrow at the moment.
Yeah, that's part of the art of being a good investor and a consistent investor. We're all humans and we all react to front page headlines, right, and scaremongering and so on. But I've learnt along the journey is look at the data. Right, it's not so much the news; it's the effect the news has that really matters to investors. So look at the data. You'll hear that American corporates are doing it tough, and they're not in crisis, but they're doing it tough, and things are. But you have a look at credit spreads, and that tells me that professional investors who are placing bets, who are underwriting bond issuance and so on, they're very calm. They're not demanding big premiums for them to invest. They're putting up with quite mild, and they're paying very, very mild and modest premiums. So what I've done basically, Alec, is try and listen to the noise, but actually react to the data.
Yeah, I like that.
That's the trick. The trick is seeing what the market's telling you. The market's telling you that everything in a corporate sense in the US is fine right now. And the final thing I do look at is what they call the equity risk premium. That's a big concept. It's a concept that you don't see too much. It doesn't tend to get a lot of airtime these days, and that's essentially it's known as the ERP, and the equity risk premium is essentially how stocks are priced versus bonds, and is there a sufficient buffer for investors to place an equity risk versus a bond market risk? And I look at the ERP, the equity risk premium, as well.
So for people that are familiar with Airlie Griffiths, they might be familiar with the funds that you offer. 3 funds that all invest in Australian and New Zealand stocks. So people might be wondering why you're so focused on so many of these US indicators. What is the reasoning there?
Yeah, that's a fair comment, and we do get asked that from time to time. It's just important for us to have a macro setting set in place, because the macro then drives how we think about company earnings, how we think about how revenues can grow, how we think about the ability of a company to cut cost and optimise its operations. And you cannot have that discussion without you need to start somewhere, and invariably the pulse and the tempo of markets is struck in the United States. The bond market direction will start there, the rest of the world will follow. So it's a really, really instructive place to start, is to get your thinking around what the US trends are suggesting, and then you superimpose it on what's happening in the Australian market, because if rates are going down in the US, they're going to be coming down here too. And so it's critical to start somewhere, and that is the best place to start. If for no other reason, it's where the capital flow is, it's where the big bets are placed. And we are simply not an island. We are captive to what happens there. So we absolutely spend time on getting the macro right, because it has such a strong influence on our underlying company assessments and how we build out our models.
Bye.